The undisputed leader of the AI revolution, the company powering our entire future, just saw one of its biggest and smartest backers silently walk away from the table. And what if this single event is the tremor that finally reveals the cracks in the entire AI boom? The artificial intelligence boom, a market force that has redefined global finance, has been largely characterized by unchecked optimism. This optimism has been fueled by a handful of titans, the Magnificent Seven, with one company, Nvidia, standing as the undisputed poster child of the revolution. Its dominance in producing the essential chips for AI has propelled the Nasdaq to staggering heights. However, the seemingly invincible facade of this AI driven market has recently been fractured by two significant successive events, a 1-2 punch that has forced investors, analysts, and the public to question whether they are witnessing the pinnacle of a boom or the precipice of a bust. The first signal came from a figure synonymous with forecasting financial calamity. Michael Burry, the investor famed for his big short against the subprime mortgage market prior to the 2008 crisis, emerged to take a significant short position against Nvidia. The notional value of this bet was reported to be approximately $187 million. While Burry's bearish stance alone was enough to raise eyebrows, it was the second blow that sent tremors through the market. SoftBank, a colossal force in global technology investment, announced the sale of its entire stake in Nvidia. This was not a modest trimming of profits or a simple portfolio rebalancing. It was a complete liquidation. The sale, valued at approximately $5.8 billion, involved dumping over 32 million shares of the market's darling. This convergence of a high profile short seller and a massive institutional exit was immediately interpreted by many as a watershed moment. The primary red flag was the totality of SoftBank's sale. Standard market strategy, when an investor still believes in a company's long term growth, is to sell a portion of the stake to lock in profits while retaining a core position to capture future appreciation. SoftBank's decision to sell 100% of its holdings was widely seen as a vote of no confidence, a tacit signal that its leadership believed Nvidia's stock was at or very near its peak. This skepticism quickly metastasized into broader fears. Analysts and layperson investors alike began to ask if this was the snowflake moment that could trigger an avalanche. Comparisons, long whispered, were now spoken aloud. Was the AI boom an echo of the dot-com bubble of 2000 or even the systemic instability of 2008? The market, it seemed, was finally being forced to confront the possibility that the AI revolution was, in fact, an AI bubble. Now, in the face of all this rampant speculation, SoftBank's leadership moved to control the narrative. The company's official stance was a stark contrast to the market's fearful interpretation. According to SoftBank's chief financial officer, the sale was not a call against Nvidia's future nor a comment on its valuation. The CFO explicitly stated that the firm held no questions about Nvidia's continued growth prospects. When pressed directly on whether the market was in an AI bubble, the CFO remained non committal, offering only, "We can't really tell from here." Instead, SoftBank framed the move as a strategic pivot, not a retreat. The $5.8 billion in capital was not being parked in cash, but actively redeployed. This was, they argued, a repositioning from the infrastructure layer of AI, the chips and hardware dominated by Nvidia, to the application and interface layer. SoftBank was signaling its belief that the next wave of value creation would come not from the companies building the shovels, but from those building the tools, platforms, and agents that consumers and businesses would actually use. The new target for this massive capital deployment was clear. SoftBank was going all in on OpenAI. The funds from the Nvidia sale were earmarked to participate in OpenAI's recent secondary share sale, which had just closed. More significantly, SoftBank confirmed it was leading a new $40 billion primary round for the AI research lab. This bet on OpenAI is part of a much grander, almost fantastical vision. The capital is intended to help fund the Stargate venture, an audacious project with OpenAI that could carry a price tag ranging from $100 billion to $500 billion. Furthermore, SoftBank has plans for a multi-billion-dollar Arizona manufacturing facility, presumably tied to this new AI centric ecosystem. To fuel this monumental shift, SoftBank has been pulling every liquidity lever at its disposal. The Nvidia sale, while massive, was only one piece. The firm also sold over $9 billion worth of T-Mobile stock and tapped a margin loan on its significant stake in ARM. This was not a whim, it was a fundamental, all encompassing strategic realignment. This strategic pivot is, without question, one of the highest stakes gambles in modern financial history. The decision is made even more dramatic by SoftBank's own history with Nvidia. This is shockingly the second time the firm has exited the chipmaker. SoftBank sold a previous stake in 2019. Had it simply held those shares, that position today, given Nvidia's subsequent 5,000% surge, would be worth approximately $210 billion. This precedent casts a long shadow, posing the question: is SoftBank once again walking away from a generational wealth creation machine too early? The risks of its new bet on OpenAI are colossal and well documented. According to financial documents reported by the Wall Street Journal, OpenAI's popular consumer facing products like ChatGPT and the video generation tool Sora are deeply unprofitable. They are celebrated by the public but burn cash at an unsustainable rate, demanding massive infrastructure costs for which the company has reportedly committed over $1.4 trillion. The projections are eye watering. The documents suggest OpenAI expects to lose $74 billion in the year 2028 alone. Its path to profitability is long and uncertain, with some analyses suggesting the company may not turn a profit until 2030. This is not a distant projection. Bernstein analysts digging into Microsoft's quarterly prints calculated that OpenAI burned through $12 billion in the third quarter of 2025. This strategy stands in stark contrast to that of its primary competitor, Anthropic. While OpenAI has pursued a consumer heavy growth at all costs model with a 70-30 consumer to enterprise split, Anthropic has been laser focused on the enterprise market, which accounts for 85% of its revenue. As a result, Anthropic is expected to reach profitability far sooner, burning, by some estimates, 14 times less cash than OpenAI. OpenAI's leadership naturally refutes this bleak financial picture. CEO Sam Altman has presented a counter narrative of spend to make money, projecting that the company is on track to generate revenues on the scale of hundreds of billions of dollars by 2030. SoftBank is, therefore, not just investing in OpenAI's technology, it is investing in Sam Altman's narrative, betting that he can successfully monetize the attention of millions of free users. This bet on the application layer, however, is more than just a preference. It's a fundamentally different thesis about where the terminal value of AI will be captured. The Nvidia play, the infrastructure bet, is essentially a bet on a hardware supplier. While Nvidia has a commanding, almost monopolistic led hardware, is historically a cyclical and competitive business. The value is immense, but it is contingent on an endless and accelerating arms race. SoftBank is wagering that the true enduring monopoly will not be in the silicon, but in the service. Not the company that sells the shovels, but the one that owns the entire gold rush town. If OpenAI, or a platform like it, becomes the definitive interface through which the world interacts with artificial intelligence, it achieves a level of platform lock in akin to Google in search or Microsoft in operating systems. In that scenario, the hundreds of billions revenue projection cited by Sam Altman begins to look less like hubris and more like a simple statement of the stakes. The application layer, in this view, is the ultimate aggregator of value. It's the platform that will charge, rent, sell subscriptions, and license its intelligence to every other business on the planet. The hardware, while critical, becomes a commoditized, albeit expensive, cost of goods sold. This is the core of the gamble. SoftBank is exchanging a wildly profitable but potentially cyclical hardware king for a deeply unprofitable but theoretically limitless platform monopoly. But this grand multi-trillion-dollar chess game is not happening in a vacuum. This entire saga unfolds within a broader market context of extreme valuations. The Magnificent Seven, with Nvidia at their head, have been responsible for the vast majority of the entire S&P 500's gains over the last 18 months. This has created a dangerous illusion of a healthy, diversified market. Millions of ordinary people, through their passive index funds, 401ks, and pension plans, believe they are safely diversified across 500 American companies. In reality, their financial futures have become inextricably tethered to the performance of a handful of AI centric tech stocks. They are not diversified, they are, without their explicit consent, making a massive, concentrated bet on the continued and exponential growth of the AI sector. A person saving for retirement who has never heard of a price to earnings ratio is now a de facto venture capitalist exposed to the same high stakes, high valuation bets as SoftBank. Their nest egg is contingent on Nvidia continuing to beat and raise every single quarter. It is contingent on the adoption of AI tools in the enterprise. And it is contingent on this entire ecosystem not being a speculative bubble. This high valuation environment, with stocks trading at 25, 30, or even 34 times forward earnings, creates a tinderbox where a single significant event like the SoftBank sale can spark widespread panic. This is what makes the 1-2 punch from Michael Burry and SoftBank so deeply unsettling. It's not just a signal for high finance traders. A significant correction or the bursting of a potential AI bubble would have catastrophic consequences for Main Street, not just institutional investors. It's a potential warning sign that the very foundation of their retirement savings may be resting on the same unstable, high valuation tinderbox that is now making institutional insiders nervous. Perhaps the most fascinating and most precarious aspect of this situation is SoftBank's own financial footing. The firm managed to post a staggering $60 billion in its most recent quarter, a figure that was 6 times higher than analyst expectations. However, a closer look reveals that these gains were not primarily from cash flow positive operations. A significant portion of this profit, reportedly $13 billion out of a $19 billion gain, came from marking up the valuation of its private holdings. Chief among these holdings was OpenAI itself. In a dizzying display of circular finance, SoftBank's books look strong because it increased its own paper valuation of OpenAI, a company that it is now liquidating other high performing assets to fund. The valuation of OpenAI has, in this manner, soared from 150 billion to $500 billion, a paper gain that bolsters SoftBank's bottom line while it simultaneously raises new cash to pour into the same venture. Other private AI holdings in its portfolio, such as Perplexity and Runway, have also received similar valuation markups. In conclusion, the AI market is at a critical, unstable inflection point. The 1-2 punch from Michael Burry and SoftBank has permanently punctured the narrative of infallible growth. SoftBank's move is a high stakes, history making gamble, a pivot from the proven, profitable infrastructure of Nvidia to the cash burning, high potential application layer of OpenAI. The outcome of this bet will not only determine the future of SoftBank, but may very well define the next phase of the AI revolution, all while the unresolved question of a bubble threatens the portfolios of investors at every level of the economy.